Is Medpace, ticker MEDP, still the biotech gem everyone's talking about? Or has its Q4 performance priced in all the upside? Let's break it down. Today, we're breaking down the executive summary, the growth engine driving their segments, their fortress balance sheet, and the final verdict on those valuation red flags. The bottom line? Medpace just delivered a massive Q4 beat, with revenue surging 32% to $708.5 million. They are dominating the small to mid-sized biotech market and projecting strong mid-teens earnings growth through 2026. Let's look at the hard data. Total revenue is up 32% year over year. GAAP earnings per share hit $4.67, a 27% jump, and adjusted EBITDA grew to $160.2 million. However, gross margins did contract by 420 basis points to 29%. Why the margin drop? It was driven by a 68% spike in pass-through expenses, which are lower margin out-of-pocket costs, and a 35% rise in operating costs as they grew their headcount. The good news is that operational efficiency remains fundamentally strong. Medpace is a U.S. powerhouse with 99% of revenue originating from U.S. contracting entities. Their core business is split between oncology and metabolic projects, which each bring in roughly $745 million, followed by central nervous system studies. Their secret sauce is a small biopharma niche, which accounts for 79% of their total revenue. This focus secures high-volume contracts, but it does make the company highly sensitive to the ups and downs of biotech capital markets. On the balance sheet side, Medpace is a fortress. They are effectively debt-free, with $0 outstanding on their credit facility and hold a massive $497 million cash stockpile. They represent the gold standard of cash generation. In Q4, they converted 137% of their EBITDA into free cash flow, totaling over $188 million, while keeping capital expenditures remarkably low at just $4.5 million. Is the price right? At an estimated price of $395, they trade at 23 times forward earnings. While this is a premium compared to peers like Fortrea, it's a premium justified by their organic growth and cash conversion. Medpace pays zero dividends, but don't let that fool you. They returned over $912 million to shareholders via buybacks in 2025, a 13% yield, and they still have $821 million in dry powder authorized for future repurchases. The bull case is their undisputed leadership in the biotech niche. The bear case, a potential funding freeze in small biotech markets, could kill revenue growth, and rising pass-through costs could continue to squeeze margins. Looking at earnings quality, their net income is backed by very strong cash flow. One red flag to watch is stock-based compensation, which grew 36%, outpacing revenue growth, and now accounts for over 6% of their EBITDA. The final verdict? Medpace offers exceptional growth and a pristine balance sheet, but the 23x valuation demands flawless execution. Keep a close eye on the biotech funding environment and compensation trends. What's your take? Is Medpace a buy at these levels, or is it getting too expensive? Let me know in the comments. If you found this Medpace earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.